How is everyone doing today? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So as the dog days of summer continue, we just continue to roll on here at the channel, bringing you the latest and greatest in banking and finance and economics and the U.S. economy, as it were. But today we're going to be looking at an article from Bank Director around CECL. And as everybody knows, CECL is our favorite system that we use in banking to basically try to calculate loan loss reserves and try to keep enough money in reserve to handle any kind of loan delinquency that may arise. But some recent changes are coming up that may really help banks with M&A transactions. And so I wanted to report on this one because, again, there have been a lot of adjustments and changes in bank regulation. The President Trump taking executive actions more recently, all in an effort to just what I call return bank M&A back to normal. Get the process of banks buying other banks, get that back to just the way it was, a normal process that takes about a year and a half to get done. And here is another example of trying to help in that area. So this article from Bank Director is titled CECL Update Eases the Math for M&A. Forthcoming rules should simplify deal accounting for would-be buyers, making some deals more attractive. Sounds fantastic. And before we get into the article, I would just note there is a link to this article in the description down below if everybody would like to go look at it. But with that being said, let's get into this here. So the Financial Accounting Standards Board, or FASB, is set to update the way banks calculate reserves for loans acquired in whole bank acquisitions. Could that change bolster bank M&A? Great question. Under the current expected credit loss model, or CECL, an acquiring bank must make additional provisions for non-purchased credit-deteriorated loans, meaning loans that have not experienced significant credit deterioration. Essentially, a buyer has to set aside extra capital to cover expected losses on loans in addition to credit loss expectations captured in the purchase accounting marks on day one following the deal closing. It's referred to as the CECL double count and has been a drag for prospective acquirers. So in other words, CECL is requiring you to put aside money for loans that are perfectly fine and haven't gone bad, and which you've already put aside money for potential losses. So thus creating the double count. So responding to industry feedback, FASB announced in May that it would issue an accounting standard update effectively eliminating the double count. Institutions will have the option to early adopt the new rule once it's released. Otherwise, FASB expects the amendments would apply for annual reporting periods beginning after December 15th, 2026. Banks are now evaluating what the rule means for them. On a July 24th investor call to discuss its pending merger with $61.1 billion Synovus Financial Corp in Columbus, Georgia, executives at $54.8 billion Pinnacle Financial Partners in Nashville, Tennessee, said their deal modeling assumed the elimination of the double count, though they noted the change did not drive the merger. Similarly, executives at $27.6 billion West Banco in Wheeling, West Virginia, weighed the potential impacts of early adoption with respect to its recent acquisition of Premier Financial Corp, which closed on March 3rd. If the rule is finalized by October of this year, we will evaluate the potential benefits and risks to adopt that change as it relates to the acquisition of Premier, Chief Financial Officer Daniel Weiss said on a July 30th earnings call. For the broader industry, the rule change will impact each bank a little bit differently. It really depends on the capital position of the bank involved in the acquisition, says Mandy Simpson, partner in charge of the accounting advisory practice at Crowe. Banks that are flush with capital may prefer to stick with the prior method rather than adopt the change early. They're already used to the existing rule, which allows for more earnings accretion after the deal is closed. The double counted credit mark flows back in as income as the loans are paid down. But on the other hand, she says, for an acquirer that has less capital, that double count could be potentially an impediment if the provision required on the non-PCD loans is really impactful to the bottom line. So the elimination of the double count may also be more meaningful for banks making relatively large acquisitions, said Kevin Brand, a partner of Crow's strategy at Transaction Advisory Group. The bigger the deal, the bigger this is relative to their capital position. He says if you're doing close to a merger of equals, that had been basically rebooking the allowance in addition to the credit mark on the entire good loan portfolio of a similar size to your own. That could be a large number that now won't need to be recorded. While the double count rule may not have necessarily been a deal breaker, it was one more added complication to deal metrics, along with interest rate and loan marks related to low rate assets, says Steven Skoten, managing director and senior research analyst at Piper Sandler and Company. Anything that reduces that tangible book value dilution on a deal at announcement is a potential future benefit, says Skoten. I'm not going to say it's been a massive impediment, but on top of everything else, it's been a great frustration. To the degree that's gone, and maybe we get a few rate cuts, those two things in tandem can continue to move us forward. So the elimination of the double count may also help sellers get a more favorable price, since the acquirer will no longer factor in the additional provision on day one, says Alan Lloyd, a principal in the insurance group with Wolf & Company. Boards discussing a potential sale should make sure that possible acquirers are familiar with the rule change and that the capital impact is accounted for in the sale price. It does shorten that earn back period in the dilution. Essentially, he says, it's a little sweetener for deals that maybe were very close but couldn't quite come to an agreement. The elimination of the CECL double count may not be the deciding factor for most would-be acquirers, but it promises to make the math easier. At the end of the day, I think the most important question is it a good deal? Lloyd says, if you're really close on pricing and you can move the needle a little bit now with less capital outflow on day one and a shorter earn back period, I think it could have some impact. So again, this is potentially a big change, but there's always a but, right? But it really depends on the size of the transaction. It depends on your capital position. If you have to put a lot of capital in versus not a lot of capital. They basically said that, if you've got a ton of capital to work with, it may not be the best thing in the world, because some of this, as you complete the acquisition and loans pay down, some of this can be accretive, as it can come back to you in the form of income. But if your bank doesn't have a whole lot of capital and you're really trying to make this acquisition work, this could be the difference. This rule change here, could help you not have to put that extra capital aside to make the deal work, right? So again, it all kind of depends on the situation. But I think overall, this is a good thing. I think it's a good rule change. It seems to make a lot of sense to me. It's just one less thing to kind of gum up the works, if you will, of a typical bank M&A transaction. So yeah, again, I thought it's a good update. I will bring, more updates like this as they come up, but we'll see what happens in the future. But with that being said, I will thank everyone for watching this episode today. And just remember, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I hope everyone has a great day out there. Thank you for listening, and I will see you again real soon.